Now, let's try to understand the key principles of capital budgeting. Always remember, whenever the idea of capital budgeting decision comes in, it is always a very, very careful analysis of cash flows. And that way, typically, when you say cash flows, think of them as incremental cash flows. Because, sure, the company might already have a certain line of products which are currently, let's say, they're into selling those products. But then a capital budgeting decision might involve introduction of a new product. And as a part of that capital budgeting decision, we are expected to evaluate what is the kind of incremental cash flows which are expected by the company. And these incremental cash flows are going to play a role whether a certain project is going to be accepted or rejected. Next is conventional versus unconventional cash flows. So when we say conventional cash flows, that means we can say that the cash flows will change the sign only once. This is a very simple way to put it. So think as if we are making one initial outlay. So let's say, imagine I am looking at a 4-year time horizon, and that way I make an initial outlay of, let's say, $1,000. And then over the next 4 years, I'm going to generate some cash flows which are positive. So let's say we call it as CF of I, whereby I runs from 1 to 4. And here if we see, there is a change in the sign of cash flows only once, because at t equal to 0, when we are investing in the project, that is the initial outlay for the project, that is a negative cash flow. But then subsequently, the project will start generating positive cash flows. We just represent them by a generic variable CF subscript I running from 1 to 4, so the 4-year cash flows. And these are treated as positive in nature. So this is an example whereby the change in the sign is happening only once. And these are typically what we call as conventional cash flow projects. However, there can be another variety as well, which we call as a non-conventional cash flow project, whereby the cash flow can change multiple times, or the sign of the cash flows will change multiple times during the project's timeline. So sure, there will be an initial outlay. Subsequently, there will be a lot of positive cash inflows from the project as well. And later on, there can be certain retirement costs of assets towards the end of the project. So again, there can be a certain negative cash flow which comes towards the end. So here, if you observe, the cash flow is changing sign multiple times, isn't it? We have a negative cash flow, which is the initial outlay. Then we have positive cash flows during the life of the project. And then again, we have a negative cash flow towards the end of the project, which you can think from asset retirement cost point of view. And these are what we call as unconventional or non-conventional cash flow projects. Also, one more important concept or a term which we come across is the idea of sunk costs. Now, one point to remember is sunk costs are something these are the ones which should not impact our final project decision, because then these are the kind of costs which are going to be incurred whether or not a firm decides to pursue a certain project opportunity or not. So, for example, let's say a company is engaging a certain marketing firm in order to do project awareness. Then this project awareness is mainly done from the point of view to understand what is the kind of market demand or potential market demand for that kind of a project. So this is more of an assessment which a company is attempting to do whether they should go ahead with a certain project or not. And this is like an example of sunk cost. And remember that sunk cost is something which should not impact our final decision making. Then there is something called as externalities linked to projects. So there can be two ways to look at externalities. There can be a negative externality or there could be a positive externality. And these are the cash flow effects which we try to link because we are accepting a certain project. So your cash flow effects can either be positive or negative, and that basically points us to the idea of a positive externality versus a negative externality upon acceptance of the project. So let's try to understand what is the meaning of negative externalities first. So When I say negative externality, that means any new product line which is being introduced, it has a potential to take away the sales which are already there from a certain existing product by the company. Technically, this is also called as a cannibalization idea under capital budgeting. So I've just taken a simple example. So uh, let's say there is a large sports shoe manufacturing company, and they launch a different range of shoes all the time. So they have walking shoes, jogging shoes, gymming shoes, running shoes, etc. So let's say a company launches a new line of running shoes with, let's say, additional air cushioning. Many times I think they call it as the carbon plate cushioning, isn't it? Which is very, very popular amongst runners. It gives like a cushioning effect. Uh, while at the same time, it can continue their older line of running shoes as well. So that way, it can happen that the older line of running shoes may be doing well, yes, but then addition of a new line of sports shoes can result in a diminishing sales for the existing line of running shoes, which the company is already selling for some time now. Now, in case this has to, I mean, when the analyst has to bring this into their model, then they must subtract a component of cash flows expected to be lost from the fall in sale of the existing products while they forecast the cash flows for the new product. So in the above example, think as if we are making a projection as to what will be the kind of sales for the new line of air cushioned sports shoes. But then when we do that, we are appreciating the fact that this is going to have an impact on the existing line of running shoes which the company is already selling. So then, uh, whenever the analyst is making that forecast for the new for sales for the new line of running shoes, they are expected to adjust it downwards in order to factor in the loss of revenue because the sales for the older line of running shoes could diminish as well. On the other hand, there can be positive externalities which results in positive cash flow effects. So it can so happen that launching of a certain new product might result in increased sales of existing products of the company as well. So this is what we call as negative externality versus a positive externality. Now, cash flow as a factor of opportunity cost. Now, many of us might have heard the term opportunity cost a lot of times in the past. It's a very commonly used term in financial analysis. Now, in very, very simple terms, an opportunity cost means evaluating cash flow that would be lost provided a certain project under review is accepted. So we can think it is like the kind of decision which a business always try to make, because then there are multiple projects which a business might be looking at, and it might say, okay, I mean, let's try to figure out what's the opportunity cost of capital for pursuing this kind of a project. So that's what we call the idea of opportunity cost. Now, there may be certain pre-existing cash flows which the firm will lose provided a new project is accepted. So just building on my example, a business might already be engaged in, let's say, three, four projects. And that way, if we decide to accept a certain new project which we are currently assessing, then that can result in certain cash flows to be lost because the new project is getting accepted. Now, a simple example or a very common example which we think from opportunity cost of view, cost of point is, let's say a company is owning a land parcel. So imagine they own a portion of that land or real estate as we call it, and it plans to set up a new plant there. So sure, the management may feel anyways we are owning the land, so that way we are just using our own asset in order to build a new plant there. However, in this case, whenever the project analysis is happening, it is very important that the cost of land also gets charged to the new project, because remember there are other purposes for that land as well. So if not for this plant, maybe the company might want to do something else on that land parcel. So that's how we try to factor in the opportunity cost of land here. So it's very important that this kind of analysis be carefully done by analysts whenever they're reviewing a certain project. And also, it's important to analyze cash flows on an after-tax basis, because remember that any company which generates revenues and generates profits, etc., finally, everyone is going to look at whatever remains in hand after payment of taxes. So that way, and it's important that we analyze post-tax cash flows whenever we are evaluating a certain project. And timing of receipt of cash flows. So think of this from a time value of money idea. And as we know, it's uh, cash flows which are received earlier are much more valuable as compared to the cash flows which are received at a later point in time, based on the ideas of time value of money, which we are always familiar. So that way, proper analysis of the timing of the receipt of cash flows becomes very, very important.